We'll wait a minute or two for a few other people to join, and then we will get going. So hope you're well, Adrian. Got Alan coming in as well. Just Henry, for your benefit, Chris Bumford's on the call, and Chris has agreed to do the Christmas quiz next Tuesday. So we'll be doing a Christmas quiz next Tuesday. Thank you to Chris Bumford for putting his hat in the ring for being the quiz master. Apparently, every answer is going to be Gary Lineker, so that's good. So should be useful.
Any suggestions for rounds are greatly received. I've got some good ideas that go. Well, hopefully good ideas. You'll be great.
Okay. Okay. We don't mind football. Obviously, it'll be just after the World Cup final. We don't mind football questions. Perhaps some deep delve into sort of DWP regulations, maybe as well, would be good. Maybe not. History, very good at history. So yeah, bring it on. That's all I can say. So let's bring a few stragglers in. We've got Andrew. Morning, Andrew. Morning, John. If you've just joined, if you could mute, that would be great. And we can then let Alex and James Fouracre start the presentation. Yeah. But yes, no, so the Christmas quiz is going to be next Tuesday. There were some very fine prizes last Christmas as well, which I think included fine red wine. So it's very well attended. Hopefully it should be a good event. Thank you, Chris, for putting yourself forward for that, by the way. So that's good. Just bring some other people in. More people joining. Ian, I'm going to mute you, Ian, if that's all right. If you've just joined, if you could mute as well, that would be good. Henry, I probably need to mute you. I think there's a bit of noise coming through. So do that. There we go. Okay, so okay, well, we'll start. I think it's a good idea to start. First of all, welcome everybody to this week's session, Coffee Morning, from Pension Playpen. Really appreciate everybody's time this morning, and hopefully we're going to have an enjoyable session from Ruffer LLP, who is going to give us a weathering the storm and investment update, and maybe what's in store for us in 2023. Alex is going to do the Alex Leonard is going to do the main part of the presentation. Alex is a fund manager, and he's ably supported by James Fouracre, who is responsible for the sort of DC side of things at Ruffer, development on the occupational side, and presumably that means bundled, unbundled, and master trust. James, so you know, you'll be chipping in at some point, I guess, and thank also to Toby Barkland from Ruffer for organising that on their side. So it's now 10:33. We've got a few more people joining, but without further ado, Alex, I'll pass over to you if I may, and I'll go on mute. If, as usual, if you have any questions, please raise a hand, or we can do Q&A at the very end. But Alex, over to you. Thanks very much indeed.
Great. And Steve, thanks very much for that introduction, and thank you all for joining this morning. As Steve flagged, I'm going to be presenting for about 20 minutes, but do feel free to cut across me, either by raising a hand or by shouting very loudly if I've seemingly ignored that hand. So just a very quick introduction as to who I am and who Ruffer are. I've been at Ruffer for nearly 17 years now. I co-manage one of our flagship global multi-asset absolute return strategies, and I'm a partner in the firm. Quick headlines on Ruffer. We're a very simple organisation. We do one thing, which is macro-driven absolute return investing, with a primacy on focusing on capital preservation and delivering an uncorrelated return stream for clients, particularly during periods of stress. And without wanting to preempt my conclusion, we do think those periods of stress are likely to become a more permanent feature of markets going forward. So thinking about how we can preserve capital for clients, and indeed preserve the asset bases of both defined benefit pension schemes and defined contribution pension schemes is going to be all the more important going forward, especially if we think you're going to continue to see increased alleviation from the stresses low interest rates have brought about on the liability side of balance sheets going forward. So with that, those are the quick headlines on Ruffer. In terms of the topics I'm going to cover today, I'm going to do a very brief recap on the environment that we've experienced for the last 40 years, then an even briefer recap on the last 12 months, and then spend the majority of the presentation talking about why we think the environment of the last 12 months is more akin to the environment we're likely to experience for the next 5 to 10 years, and why we are unlikely to be reverting to the environment of the last 40 years, which has been so friendly to asset owners generally. The rules of the last 40 years have essentially been buy stuff, combine it with some bonds, and generally not sell at the bottom, and then you've been fine. That's definitely been turned on its head over the last 12 months, and it's important to understand why that's been the case. So very quickly, how would we describe the environment that we've operated in, encompassing the careers of pretty much everyone operating in asset management and pension scheme industry since the beginning of the 1980s? Rather pompously, I describe it as an intertemporal disequilibrium. But what does that mean? Starting in the very top left-hand side of the page, you had a number of positive supply shocks superimposed on the global economy, whether that was the emergence of Russia, the collapse of the Soviet Union, women joining the workforce, or a huge technology revolution. You had persistent supply side shocks, lowering inflation in the global economy. That meant that every time that you had the risk of a recession, because the predominant threat was that of deflation, interest rates would continue to fall, which would incentivize everyone to borrow, to spend, and drive asset prices higher. Increasingly, that meant that there was more financial intermediation, whether that was through structuring or leverage or taking on more illiquidity risk. That inevitably ended up in excess, which had to be stamped on by policymakers via policy tightening, a financial crisis, and then rinse and repeat. Because the threat remained deflationary, central banks would respond in kind, meaning that every time you had a shock, real interest rates would ratchet lower and lower, which has had the effect of creating a persistently disinflationary environment with both distorted asset markets, but also distorted liabilities if you're a DB pension scheme. And what I'm illustrating here is the extent of which that distortion has just accelerated post-COVID, where financial assets in the real economy now dwarf the total size of the economy itself. So whenever you see alligator jaws such as this, it probably causes pause for thought. But the interaction of that disinflationary wind coming from the supply side of the economy, combined with central banks trying to create inflation, has led to significantly distorted markets. Now, over the last 12 to 18 months, a new era has potentially dawned. We've seen inflation rise to levels not seen since the late 1970s, which has really broken the reaction function of central banks. They're far more interested in containing rather than creating inflation. Now, we can discuss this more in the Q&A, but just to provide a hint, we don't necessarily think we're heading straight back to the 1970s, but potentially heading back more to a period like the 1940s and 50s, where inflation was much more volatile in nature. But this inflation shock that has definitely been underestimated by central banks and asset managers aplenty has seen an environment where there has essentially been no hiding place for any asset owner. What the chart on screen shows provides the return of the best performing asset class in the world on a quarter by quarter basis. So for the last 4 decades, there has always been somewhere to hide. There has always been an asset class that has delivered a positive return in every single quarter dating back to 1980. 2022 has been extraordinary, is that irrespective of where you've put capital this year, you've been unable to deliver a positive return through Q1, Q2, Q3. Irrespective of whatever asset class you're in, you were guaranteed to have a loss in that quarter. So it's been a pretty frightening place for asset owners. And that's really been driven by the response to the inflation shock that we've seen this year, which has seen the sharpest tightening in monetary policy, driven by rate hikes across the world that we had seen since the late 1980s. So unsurprisingly, when money gets more expensive, asset prices struggle, and it's created this environment where there has been very few hiding places. Now, currently, markets are and market participants are setting the scene for 2023, and the hope is that we've seen the end of this tightening cycle, and that is potentially going to see inflation start coming back down, and revert to the conditions that we've all enjoyed through most of the last 3 to 4 decades. Without wanting to sour the Christmas mood too much, I'm here to say we think that's fundamentally unlikely, and the environment and the external environment we're moving into is going to be a regime that is going to be characterized by a much less friendly environment for asset owners going forward, and return of capital is potentially going to need to be prioritized over return on capital in the world that we think we are now well and truly in. So what is that world? Now, I've got a very hugely technical chart on the screen here, which is the path that we think inflation is likely to follow over the foreseeable future. So unsurprisingly, we should have been clear that inflation was going to become a problem, as is always the case when something's published on the front page of Bloomberg Business Week. Automatically, you should operate and go the other direction. So late 2019, Bloomberg Business Week asked the question, is inflation dead? Now, we're pretty unequivocal that the structural trend for inflation is going to follow this green line, the light green line. We are going to see structurally higher inflation on a consistent period going forward. Now, the nature of it means that it's unlikely to be linear. There will be periods like the one that we have just experienced, where inflation is seemingly out of control, and everyone's starting to worry about the 1970s, or indeed in extremis Weimar Germany, or Zimbabwe. There will also be periods like the one that we are probably going to go through in the next 12 months, where the world will feel quite deflationary again. Now, importantly, this is not a reversion to the previous regime. It is volatility around a structurally rising trend. Now, the trouble with that is that the portfolio you're going to want to own at the peaks of these inflationary cycles is going to be quite different from the portfolio you might want to own at the trough, which is going to make the job of setting a strategic asset allocation incredibly challenging, and noting that many people are going to be going through triennial reviews in the next 6 months, or indeed setting long-term glide paths for DC schemes. That is ultimately something that we think is fraught with danger, because you are going to need a much more dynamic approach to asset allocation if this is going to be the overwhelming force for the next decade. So at the moment, I mentioned there definitely is a degree of hope in financial markets that inflation is going to come back down to 2% pretty quickly, and is going to stay there and allow central banks to be able to respond when there are crises in markets. Looking back over time, we would argue that that's potentially the triumph of hope over reality. What you're looking at on screen now is the number of years it takes for inflation to come back to target when it hits above 5%. Now, currently within financial markets, everyone's assuming inflation is going to come back to target within 1 or 2 years. As you can see from this chart, every time there has been an inflationary event in Western economies in the last half a century, on average, it's taken 8 to 10 years for that inflation rate to come back to target. So the hope within markets at the moment perhaps it is ignoring events of history. And I think what's important to note is all of these periods were inflationary impulses that occurred in a deflationary world. Now that the world that we're operating in is fundamentally more inflationary, the idea of coming back persistently to 2% feels quite unlikely from our perspective. Despite that, and despite the evidence to that, financial markets still think central banks will get it right. This is the picture that I think Jerome Powell, chairman of the Federal Reserve, kisses before he goes to bed every night. No, he doesn't kiss his wife. He doesn't kiss his children. He congratulates himself by looking at this chart, which is the 5-year forward inflation expectation rate in the United States. Why is he so chuffed by this? It's the chart that tells you that he still has credibility. People still believe central bankers will be able to engineer the immaculate disinflation, where inflation will cease to be a problem, and it was only caused by COVID or the war in Russia and the Ukraine. As I said, perhaps this is the triumph of hope over reality. Now, the reality is that actually the Fed have very limited scope to be able to cut interest rates. Here we're looking at a measure of slack in the labour market, and what you can see is that conditions remain incredibly tight. So even if there is a recession next year, whilst inflation remains high and unemployment remains low and tight, the scope for the Federal Reserve to respond to a financial market shock, and I think this is true for other central banks around the world, is relatively limited in nature. Now, I've talked about the world being structurally more inflationary, and I think that's clearly evidenced with this chart. So what this is looking at is the price of goods inflation in the G7 countries. Now, what you can see underneath the line, and really since China joined the World Trade Organization in 1994, you can see that goods prices have been persistently deflating. So the supply side shock that I started with, really since for the entirety of that period. Many people say that the inflation that we are experiencing at the moment is entirely due to supply chain disruption caused by COVID and the war in Eastern Europe. Our observation was that the disinflationary trends were ending well before COVID even was something that we acknowledge in the world. So the problem is unlikely to go away easily, and we're potentially in the world where the supply side of the economy, principally for goods, are going to be much more inflationary on an ongoing basis. So that is going to change the ability of central banks to respond to financial crises should they occur. Now, what does that mean for financial markets? If rates are likely to continue to be high, for the first time in a while, cash is offering a genuine alternative to investors taking risk. Here you can see the yield or the earnings yield on companies in the United States compared to cash rates. So for the first time in a while, cash is now an alternative investment. So we are moving from a world that could previously have been characterized by TINA, which is there is no alternative, to one where there is now genuinely an alternative to taking risk, either in equities or illiquid assets. Despite that, there has not been a deallocation away from risky assets at all during this year. So despite the fact that the S&P and global equities are down 10 to 20% at different points, money has still been flowing into the equity market. This to us ultimately means that whilst 2022 has been a difficult year, it is a long way from being the sort of dislocative clear out you would usually expect within a bear market. So allocating money to risky assets to us still feels something that requires a large degree of caution, particularly when you're not being rewarded to do so. This is something that is referred to as the equity risk premium. And what you can see is, despite the fact that equity markets have fallen by 20% in some cases this year, investors are still not being rewarded for taking additional equity market risk. So you are taking more risk to get a lower return potentially on a forward-looking basis. And we should perhaps not be surprised that the world is becoming more dangerous. What evidence tells you is that when rates move up too quickly, something always tends to break. Now, this is something that we think is going to be exacerbated by liquidity risk within financial markets. I managed to speak for 15 minutes without mentioning LDI, but we do think that the LDI crisis we saw in September was not a crisis caused by leverage, but a crisis caused by illiquidity and an inability to find liquid forms of collateral to support derivative trading. Now, that illiquidity is something that we think is going to create more problems for financial markets generally in the year ahead. So what you are looking at on the screen at the moment is the results of an academic exercise that were carried out in 2018, showing investors' allocation to risky assets at different levels of interest rates. Now, what you can see as rates fall, people allocate more to risk, and people that is also including institutions, allocate more to risk as rates fall. And this happens in relatively steady fashion as rates fall. The trouble is, this experiment has not been carried out in reverse. And our observation is that as rates rise, things can be very orderly for quite some time until a point that liquidity is required within financial markets, at which point things can become quite dislocative, which is exactly what we saw in the UK gilt market in September, and an environment that we think is likely to occur in other asset markets in the next year ahead, particularly being amplified by the amount of illiquid private assets that sit on institutional investors' balance sheets. So significant caution is warranted. And perhaps more importantly, when it comes to setting strategic asset allocations, where one finds protection is going to be much more important. Now, I think this is my favorite chart within the deck. It's looking at the real return that you've received on treasuries in the United States, dating back to 1910. What you can see is how extraordinary the last 4 decades have been, where bonds have been able to provide you not only yield, but also huge capital returns. Our observation is that if you are moving into an environment that is going to be characterized by much more volatile and uncertain levels of inflation, we should expect something much more akin to the previous 8 decades, where bonds provided you a yield, but not much else. That means that you're going to need to find a very different way of getting protection within portfolios in the new regime, which we're pretty unequivocal we've entered in. So when people are setting their strategic asset allocations going forward, we think there are 4 rules that need to be followed. First and foremost, be active. As I illustrated with the chart around inflation volatility, no single portfolio or single strategy is going to be successful consistently. So having a much more active approach to asset allocation is going to be necessary to protect schemes and to drive returns on a forward-looking basis. If you're not going to get protection from bonds, we think it's going to be essential to actually give up some upside, so actually pay to get genuine convexity and protection and insurance within portfolios. Perhaps this is somewhat perverse, if we're moving into an inflationary world, cash is a uniquely bad asset. But actually, if inflation and higher rates are doing considerable damage to asset markets, having the ability and the liquidity to take advantage of dislocations within asset markets is going to be fundamental in the new regime that we're operating in. So having much more use of cash and fewer assets tied up in illiquid in investments, we think is going to be essential for getting through this environment. And perhaps finally, just something that was clearly emphasized by the LDI crisis, which was all about portfolio optimization and asset market optimization. That is ultimately going to amplify shocks within schemes and within portfolios. So in the world that we think we're moving into, which is likely to become uniquely unfriendly to the asset owner, prioritizing resilience over optimization, we think is going to be key. I'm going to pause there. Apologies if I've ignored any hands up as I've gone along, but very happy to take questions now.
That was very informative, Alex. Thank you very much indeed. Henry, you might as well ask your question, Henry, that you, as an amateur, I think, on the investment side, Henry. Why don't you ask your question and then go from there?
Yeah, I mean, it strikes me that we were all heavily into bonds one way or another, whether we were DC investors or whether we were DB investors at the beginning of this year. We've seen bonds values reduce massively, more than probably equity values. But we thought we were in a risk-free asset. And now we're being told that this was foreseeable. We could see the alligator jaws are open. So with so many predictions that interest rates were going to rise this year, why weren't bond allocations reduced?
Look, I think that there's one simple fact to that, Henry, which is there is a necessity of some bond allocations to match future liabilities. So actuaries will require that. The more cynical side of me is sort of draw on the sort of parable of what noise does a tree make if it falls in the woods question. The reality is no one in the investment industry, appreciate I'm one of the younger people on the call today, with the greatest respect intended, but there are very few people even on today's call that have ever experienced an environment where bond prices have fallen. So whenever you're building your asset allocation models, all you've had to know is it's the risk-free asset and they always go up. So it back tests incredibly well, and people are not incentivized to look at things that they haven't experienced in the past. But perhaps that's overly cynical on my behalf, Henry.
Well, it's quite worrying because we put a lot of our trust in trustees, fiduciary managers, investment consultants, LDI managers. I mean, these are all people who we pay to help take decisions on our behalf. And most of us are not taking decisions. We're in default strategies. And we hear conversations like this, see alligator jaws like the ones you showed us. And we ask, well, what the hell are we paying you guys money for?
I mean, there are, without wanting to go down too much of a rabbit hole, Henry, the reality is that there are many incentives in this industry that focus on maximizing returns from good decisions, without wanting to overly push Ruffer. The way that this business was founded was based around capital preservation first and foremost, and effectively minimizing losses from bad decisions, which I think is a completely different way of looking at things from looking at things through the other end of the telescope from most of the investment industry. And we do think that the last 4 decades has all been around optimization and how you can maximize returns, whereas I think now having a mindset that's going to be focused much more on capital preservation is going to be key, particularly for people like yourself, Henry, who are in that decumulation stage of their life cycle.
He's only
I-
40, Alex.
Yeah. Sally Bridgeton spoke at a recent event I was at about status quo bias, and she said that behaviourally speaking, it looked as if everybody in the value chain had got stuck in a sort of permanent sense that everything was going to be okay, even though the facts were telling them something different. So I'm putting it to you, Alex, is that how can we feel that trust in the fund management industry? What do you guys have to do to make us feel that if we gave you our money, you would do it differently?
I think I don't want to sort of go down a rabbit hole of talking about how Ruffer do things differently.
Oh, do you're here to talk about Ruffer? How would you do it differently?
I mean, I think on the basis that invite, our business was entirely founded around the basis of keeping clients safe and focusing on not losing money. And then if you generate a return as a residual of that, then great. That's a very different way of thinking about risk and capital allocation from everyone else in the investment industry, who are much more interested in working out how they can maximize their returns. So I think you do need a completely different mindset to how you make decisions on a forward-looking basis.
And yeah, okay. Well, I think that's as good a pitch as any.
Thank you, Henry. Okay, we've got Neil. Neil's got his hand up. Neil, want to unmute and ask your question, Neil?
It's more of a comment, I'm afraid, Steve. If you look at the last 40 years, and I'm afraid, Alex, I am old enough to have been trading in 1982. If you look at the last 40 odd years, then you've seen bond yields move from that 15% that you had on one of your slides. And I can remember when long dated gilts yielded 15% and long dated treasuries yielded 14 or 15%, down to 1 in the round. And therefore, holding bonds for the last 40 years, you've just made money systematically, either by the running on it for the 1980s or a combination of running and compression since the 90s onwards. If you combine that with 20 years at the end of the last century of 12% real returns in kind of the UK and US stock market, a bumpy ride for 10 years and beyond since. But you've got a mindset where most people have kind of bought and held.
Yeah.
And they've not come to much harm. And I suppose, partially to try and answer Henry's question, market timing is an interesting game. And yes, we've all known that bond yields at 1% are unsustainable, but trying to pick exactly when they're going to break and exactly what's going to be the cause to make them break, people have been saying for several years, bond yields are going to have to rise. And the answer is yes, they are. And yes, they have. And what's caused it this year are a raft of different things. But we spent our lives going, markets are going to break eventually. And the question really, if you want to back your money and say they're going to break, is are your pockets deep enough to hold in the game if they don't? And the TMT bubble in the late 1990s certainly gave some great examples of value to investors who got carried out feet first. So, it's easy to say, why didn't we see it? And looking back, you can always tell why something has happened or what's triggered it. But looking forward is a little bit harder.
I mean, the one thing I would observe, I think that's very prescient comments, Neil. I think the couple of things that I would observe on the back of that, you're absolutely right. The sort of recipe for the last 40 years has been buy stuff and combine it with some bonds, and generally both have gone up in value and been negative correlated during times of stress. If we're moving into a very different inflation regime, which we're certain that we are, the opposite is potentially true, and holding stuff is probably not going to be the way forward. I think in terms of the sort of market timing point, time is ultimately the enemy of investors. It's much easier to identify what is going to happen than when it's going to happen. So the key for us is to identify what is going to happen, protect against it, then spend the rest of your energies asking yourself, what if you're wrong? How can you hold that protection for longer than it's required? The one thing I'd sort of add when looking at external environments, very, very simply, money can only really find its way to 4 places in an economy: the management of companies, the shareholders of companies, governments, and workers. All of the value and all of the money of the last 4 decades has accrued to the first 2. the management and the shareholders of companies, effectively asset owners, at the expense of governments and workers. The pendulum doesn't need to swing back very far in the other direction to create a very dangerous environment for anyone who owns assets. And we're pretty unequivocal that the pendulum is swinging back.
Yeah, I agree with that. Interesting comment that, Alex, definitely. We've got Chris Bumford, who's our quizmaster next week, but Chris is an actuary as well. I'll come to you, Chris, in a minute. Andrew Main, you put your hand up.
Alex, the biggest trend in the world is Europe is declining working population dramatically over the next 25, 30 years, whereas the US through natural forces is not declining as quickly by a long, long way. That's going to have quite a tremendous influence on social policy, the whole meaning of life. I think there's something like 50 million people come out of the working age of Europe over the next 15, 20 years. I mean, does that influence your long-term thinking?
Absolutely, Andrew. So I talked at the start about sort of the supply side shocks that have made the world disinflationary, which I think you could as the first as huge gluts of workers entering the world, whether that's from China, whether that's from the Soviet Union, although it's less obvious to tell from looking at the participants of this call, Sarah excluding. Women have joined the workforce in the last 3 decades, which is another huge disinflationary pressure. The likes of these one-offs are not going to be repeated, and you do have an aging populations that are going to see workforces decline, which is something that informs our view of the world, that the supply side of the economy is structurally going to be more inflationary in nature. The other thing that I would add to that is, for the last 4 decades, it has been central banks who have been responsible for creating demand. So whenever there's been a crisis, they've been the ones through monetary policy that have been creating demand. They've kind of run out of steam now. So it is now in government's hands to create demand. Now, central banks were great because you know what their incentive was, which was to bring inflation back to target. Governments are equally great because you know what their incentive is. And apologies if there are anyone who's got an ideological view about government on the call, but the only incentive government has is to get re-elected. Which is going to change you get very different response functions when you get crises, which will be more focused on protecting the man on the street than the person who owns houses on the street.
Yeah, I understand that. Absolutely. So we've got a number of people here involved with DC, a number of people here involved with DB. I'm going to go to Chris Bumford because I think Chris is an actuary. And probably I'll then come to Steve Johnson, who's put his hand up, and also to Sarah Brennan, who's a trustee as well. If you're involved with occupational pensions, where do we go from here, I think? Chris, do you just want to unmute as an actuary and say, what does this mean for, next sort of 3 to 5 year outlook for DB liabilities? And how can people who, like Alex, who's a fund manager, can help in this environment? What are actuaries saying to your clients?
Well, yeah, I mean, it's a good question. There was one thing I was going to ask Alex, sort of related to that, and before coming to that, I mean, I was interested in your use of the sort of term risk-free rate, and as actuaries, that's a really helpful figure to have, and we use that quite a lot. But we base it on government bonds. If we've sort of learned anything, as well as LDI over the last few months, we know if the government decides to gamble on a budget that is hopeful of future growth and hoping to get that, then the yields go up, and we still call it the risk-free rate. I was just checking: is that the risk-free rate you were using, or do you have adjust for that, or do we just sort of assume the government will pay given we know they default and are going to default in 2030 when the when the RPI changes to CPIH.
So, I mean, when we think about the risk-free rate on those charts, that's sort of the cash rate rather than the long bond rate. It's slightly answering a different. I'm going to give two answers to a slightly different question from the one that you've asked, Chris. And the first one might cause you as an actuary to fall off your chair because it goes against everything that you've learned from your career, which is unless, particularly if you've got schemes that have inflation caps, you don't need to worry about your liabilities. Rates are going up, liabilities are going down. The only thing you as a trustee need to worry about is what happens to your asset base when your liabilities go down. Now, that's definitely a completely different equation if you've got uncapped liabilities from an inflation standpoint. But there's so much focus on liabilities because no one's had to worry about assets for the last 4 decades. The focus needs to be on what happens to your asset base when your liabilities shrink, because provided you have inflation caps, that liabilities are coming down. The second point that I want to make is governments are going to default, but it's not going to be a hard default. It's going to be an inflationary default. If you can have a prolonged period of financial repression, which is interest rates held below the prevailing rate of inflation, that will allow the debts to be eroded away. Now, put it simply, as Russell Napier, who's a Northern Irish economist, describes it, that is stealing from old people slowly. But it's still a default, and we're pretty clear that if the chronic problem is too much debt, it needs to be defaulted on in some shape or form.
Thanks. Yeah, no, it's something that we've always had in our calculations for numerous years, that we kind of match and have this risk-free rate. And I do worry a little bit that it stops us having a sensible. It makes there a right answer about this is risk-free, this is the right answer, and makes it harder to have a sensible conversation about the amount of risk to include. And going on to your question, Steve, about the next sort of 3 to 5 years, I mean, it's difficult, isn't it? Because trustees have their views on what they need to do to protect their members and always protecting their members. They've also got the pensions regulators' view on what is needed to protect members, and they have to be seen to be protecting in that way. And that has generally been a sort of more gilts-based sort of push to invest in those assets. And if the trend in gilts continues, then that could cause issues. So it's going to lead to some interesting trustee conversations, and I think they're going to hopefully, like you say, no one wants to be sort of buying at the high end and selling at the low end of the market, and that there's a potential for that. But I think there's going to be some interesting conversations with investment consultants about the best way of managing and over the next few years in the new environment.
Okay, Chris, thanks. Steve, you had your hand raised for a while. Do you want to come in, Steve Johnson? I think you're on mute, Steve, are you? No, I think you're still on mute. Hang on, let's just see if I can do... No, you're still on mute, Steve. Let's go to Neil, and then we'll come back to Steve. Yeah, Neil, can you unmute and ask? Yeah.
Just a very quick comment. When you're talking about liabilities coming down, you're talking about the present value of liabilities coming down. The liabilities won't be changing themselves, and as trustees, you're going to worry about paying those liabilities. So maybe the present value is coming down, but what happens to your assets is actually an important point, because that's the pot out of which you'll start paying the pensions, unless or until you go back to the sponsor for more.
Yeah, agree with that entirely now.
Yeah, absolutely. Michael Bromwich, you've got your hand raised. Do you want to unmute and ask a question?
Yeah. When people show things like you have today, it takes a while to think about them. But are you not leading to a world where the world is going to become highly depressed and deflationary, and also a world where most of the things we've talked about are all reversed. Is that the case, or am I misunderstanding?
I think there will be periods that feel quite deflationary, but the overwhelming trend we think is going to be much more inflationary in nature, Michael, where now that might mean that people end up feeling depressed, but it doesn't end up being a depression like you saw in the 1920s and 30s. It's much more inflationary in nature, like what you saw immediately after in the sort of period of the 1940s and 50s, and in extremis like you saw in the 1970s. Now that is not a good environment for anyone who owns assets, but it's definitely not a depression per se.
Well, if assets aren't valuable or are declining in value all the while, people are going to stop holding them.
Correct.
In which case, doesn't much of the economy disappear?
Unless there is always a price for something, and I think what you saw in the 70s is that those who had assets suffered much more than those that didn't, and ultimately this is going to solve a lot of the problems in society, in that you need to see a rebalancing from wealth from those who have to those that don't, and that is going to be the consequence to this. People of my generation and younger need to be able to buy houses in a way that they can't do at the moment. So you need to see house prices and asset prices come down very considerably. Otherwise, the tensions in the political world will only grow.
Yeah, but now you're changing the world completely, if you see what I mean. What you're doing is saying these are ills of the world, and guess what? What we're going to do solves those. I always worry about people who say things like that.
I mean, I'm not saying I'm going to solve anything, Michael. I'm saying that I'm just talking to the external environment as we see it.
Well, I think Alex for Prime Minister, don't you, Michael? That's,
Indeed.
change the world. Yeah, why not? That's good.
Yeah, why not?
Michael, thank you for your question. Steve Johnson, you're back now. Do you want to try and unmute, and does it work?
Yeah, can you hear me now?
Yay, there we go. We can hear you. Yay.
Apologies for my IT problems. Thanks, Steve. Alex, great thought-provoking presentation. A couple of quick questions from me. QT, I'd be interested in your views on that. And is that one of those liquidity challenges you mentioned on the horizon? And then also you mentioned giving up some upside return for protection. Is that swapping investment risk for credit risk? Is that what you're talking about?
I think QT is a mechanical withdrawal of liquidity from the financial system at a time that the financial system probably can't tolerate it.
Yeah.
There are other inputs into that, and aware of Steve's time limits, probably 12 minutes doesn't give us the opportunity to go into the science of the Federal Reserve's balance sheet. But needless to say, we remain quite concerned around the liquidity withdrawal from the financial system. And sorry, Steve, your second question?
Yeah, you mentioned giving potentially some upside return for protection. Yeah.
I mean, no, I think from our side of things, protection in that instance, we effectively mean paying for it through things like derivative structures, rather than actually we do see that credit, whether that's private credit or investment grade credit, is amongst the most dangerous areas of markets at the moment, potentially, where you have the sort of liquidity mismatches that could be amplified by outflows.
No, when I meant swap investment risk for credit risk, that's buying the protection from an investment bank. Yeah.
Correct.
Okay, thanks for that, Steve. Some good questions there. John Hampton, if you want to unmute, you were talking about where do we go from here with uncapped inflation? Do you want to unmute, John, and ask your question?
Yeah, so thank you. I had the fortune or unfortunate situation of setting up a new plan and moving my employees out of CNPP into our own scheme. It's a benefit structure that has uncapped inflation. I heard you reference it, and we're just going into evaluation. But fundamentally, it's about saying lots of talk in the press about big closed schemes. What about the ones that are open and protected by statutory requirements? And where do we go from here in this environment?
Well, I think the danger with uncapped liabilities is they, to build on the question, my response to Chris's comment earlier, if your liabilities are uncapped, it's much harder for them to be defaulted on softly. An inflationary default is a soft default rather than a hard default. And I think that's the danger that we see that they will have, someone's going to have to fund that gap, or there have been promises made that can't be kept.
Yeah, I mean, I think the other side of it is this whole idea that if inflation doesn't come down quickly, and I must admit, I share the view that it's going to take a long time for it to come down, then you get an argument back from employees saying, actually, I could jump out of the scheme, and my benefits would go up in deferment quicker than they go up when I'm actually contributing to it, because we've got a pensionable pay cap in place. So there's some real dynamic here about saying that long-term prediction of inflation is going to be quite crucial to future funding arrangements.
I mean, the one thing I would say, John, is it's unlikely to be linear, in that you're probably not going to go from 5 to 15% inflation in a straight line. There will be periods where inflation will fall quite sharply. That is always the nature of how these inflationary periods evolve, in that they are. And this comes back to the point about government activism. I think where you get those periods that will feel quite deflationary, I think that's where you see governments stepping in and potentially amplifying the next inflationary impulse down the line. So from our side of things, higher average inflation, but much more volatility around that average.
Okay, thank you.
Just following on from that question, John, do you see a lot of open DB schemes seriously considering closing accrual now?
Well, I mean, in our case, I don't see it happening, because, as you say, most have got a cap. It's quite unusual to have uncapped liabilities. So that's the bit where certainly that's the dynamic we're just struggling with a little bit, to make sure employees make the right decision. Because, as you say, it looks great saying, well, actually, if I jumped out a year ago, my benefits will have gone up by 10% this year. Whereas if I've got benefit accrual in the scheme, I'm actually getting less than that, and I'm still paying my 5% into the scheme. So it's that sort of dynamic that clearly the unions quite easily use, in terms of saying, you know, come on, company, why can't you give us 5% increase on pensionable pay? And clearly that just makes it completely unaffordable in the current climate. And it goes back to, it's an old scheme, there's a big population there, but they are all of a certain age moving towards retirement, just like we talked about earlier, that actually that's another factor coming through, and the new guys are all DC.
Yeah, okay. I've got a question about DC in a minute, but I'm conscious that John Mather has put a couple of comments. John, are you able to unmute, John, or and put your views forward, or is that possible? No, we can't hear you. We can't hear you. So sorry, it's fine. It's fine. So just following on from John Hampton's point regarding DC, and this might bring in James Foraker, obviously, who's sort of the DC sort of a guru at Ruffer as well. What are you seeing on DC? Are you seeing that trustees are starting to look for, because as Henry mentioned earlier, default funds is the thing. Are you now being more and more part of a default fund strategy? And are they looking for your, you know, the route, the stick of rock that's Ruffer seems to be, you know, keeping the cash fairly safe and not taking too much risk? Are you seeing growth in that area, James?
Yeah, I think we are, and I think largely that reflects on the circumstances that we've seen this year. So I think we predominantly, from what we've seen to date, the usage of Ruffer within DC schemes is twofold. Firstly, it's held during the growth phase for markets like this one that we've seen this year, that we've witnessed this year, whereby should markets perform, the portfolio will perform because they're set up well with bonds and equities to do so. However, if you have turbulent periods of time, Ruffer offers a substantial ballast to the portfolio during that growth phase. Equally, during the pre-retirement and decumulation phase, we seem to see a sort of 3x or 4x holding of Ruffer, whereby there's clearly limited appetite for any volatility during that period of time where you approach retirement, and because of the sort of return volatility statistics of the Ruffer strategy over the course of the last 3 decades have satisfied the demands of those underlying members well. I think, you know, it had been touched on earlier in the conversation that, you know, a lot of the conversations we're having with clients, whilst the LDI fallout was, of course, you know, entirely focused on the DB pension schemes, we think there are lessons to be learned on the DC side as well, with a view to the significant bond and gilt holdings during the pre-retirement phase, as I say, in particular, no longer the sort of cautious, low-risk asset or viewed to be that as they once were, and instead, you know, how does one view a sort of diversified alternative to that? One thing we haven't touched on a huge amount is how bonds and equities might continue to perform in correlation moving forwards as well. And again, you know, as Alex has alluded to earlier on in the call, if we think the environment that follows this year is to be similar as the one we've witnessed this year, then again, should equities decline, bonds will do something similar, or vice versa. And again, the need for a diversifier in that space.
Yeah. And one thing we haven't touched upon is probably drawdown. You know, if you've got a 250, 500, 700 grand drawdown pot, you're probably fairly scared at the moment to invest. And you go, well, what, you know, I mean, you know, if you're 60, 70 years old, you've got a 20, 25 year time horizon. But, you know, products like you're talking about, Alex and James, that's a good alternative. If you've got $500,000 in a drawdown, you need the drawdown to motor to justify it, but equally, do you want to fully expose it to full out equity risk? I don't know. I mean, what are you seeing also development of products or funds in that space? Because what's the alternative, I guess, is the question.
Yeah, I think, you know, just speaking objectively on, you know, I think the only way to judge Ruffer in that instance is to say, well, how have Ruffer performed during periods of market stress? And if you reflect on COVID, global financial crisis, across those 3 periods, the markets were down simultaneously, or sorry, cumulatively over 90%. Ruffer was up over 60%. Again, this year, bond and equity markets have fluctuated anywhere between -10 and 15, and the Ruffer strategy is up 6%. So, you know, we think that over the reflection of those last 3 decades, at times of significant market stress, you know, the performance has come to the fore as you know, as a capital preservation strategy, as we intend it to.
I think that's pretty amazing, actually. In based on that slide that Alex put up with the negativity of the various sectors in the various quarters, that's very impressive. What was the main reason for that strategy working, James? Do you know, or Alex? Do you know where did that +6 come from?
So I think it came from those main rules that I flagged at the end of the presentation, Steve, which is our willingness to be active, the desire to and ability to pay for protection in portfolios, and also being more dynamic around our use of cash.
Yeah, that is very, very impressive. John Mather, you've come back. Do you want to see if you can unmute and make your point, and then we can wrap up? Can we hear you now, John? No. Santa will bring you you know, recording system or something like that. Maybe, you never know, or something like that. So yeah, apologies on that. Alex, it's been a brilliant presentation. Are there any other questions for Alex or James? It's been a fantastic session, and yeah, I mean, crikey, Alex, Ruffer has got some very strong opinions, strong rationale, strong investment proposition, and that's very, very impressive. So thank you to Alex, thank you to James, and thanks to Toby as well. for that presentation. Are you happy if anybody wants to see a copy of that, Alex, for the slides? Are you happy for me to sort of ask for a copy to send out to a few people? Is that possible?
Yeah, I'll send that. I'll get Toby to send that over to you, Steve.
Yeah, that's fantastic. That's brilliant. Okay, so the video of today's session will be online later, and you know, really impressed with that. Absolutely fantastic. Just as a reminder, if any of you are in London next Monday, we have our Christmas drinks at the Albion pub in Ludgate Circus. That's probably not far from you, Alex, I guess. So you know, you might even get down there for a free drink. But yeah, everybody's welcome at the Albion pub at Ludgate. And on Tuesday, we will be having our Christmas quiz, ably hosted by Chris Bunford, who will put forward the questions. And so if you'd like to join the Christmas quiz, that will be next Tuesday. Apart from that, if you're not a Pension Playpen member, please join. If you are a Pension Playpen member, please use the Invite Friends tab to encourage others to join as well. If we don't talk to you again, even though it's the 13th of December, I would say, if you don't come on the quiz or I won't see you at the Christmas party, then have a great Christmas. And thank you for your continued support of Pension Playpen. Henry and I are delighted that you know, we're now over 1,200 members and growing. And we want to give back and create knowledge and create opportunity and create networking, and that's what Pension Playpen's all about. So we really appreciate everybody's input and time. And as we always say, and can't believe it's now mid-December, we pray for peace in the East. So let's hope there's some movement there, and that might settle markets as well, Alex. So if we can get the Russian thing sorted out, that'd be really great. If you're footy fans, enjoy the game tonight, enjoy the game tomorrow night, and enjoy Sunday. So we won't talk about England, so there we go. Enjoy the rest of your day, enjoy the rest of your week, and thanks again for your time, Alex and James and Toby. Great presentation, and Merry Christmas to you all if we don't speak again. Thanks a lot. Cheers. Take care.
Thank you. Bye-bye.
Cheers, Neil. Thanks.
Thank you.
Cheers, Chris. Thanks. Bye.